Home buyers are starting to throw in the towel. After a year of high mortgage rates, high home prices, and no homes for sale, we are now starting to see home sales begin to fall. And here's why. If you wanted to buy this $500,000 home in 2021, you'd be able to get a 3% mortgage. And your 3% mortgage, assuming you put 20% down, is going to cost you around $1,700 a month for this $500,000 home. In 2023, assuming you can buy this home at a discounted price, even though many times you're going to pay more money than today, but let's just assume that you're going to get a discounted price and you can buy the home for $480,000. Now you're going to get a 7.5% mortgage, which means if you put 20% down, you have a smaller down payment if you pay less, but your monthly payments are going to grow to over $2,700 a month. So we're talking about a 58% monthly increase over just the last couple of years. So now what are the options to make buying a home more affordable? Well, there are three potential options. Number one is that incomes could rise. Number two is that your mortgage rates can fall. Or number three is that your home prices can fall. So if we start by talking about incomes rising, incomes generally depend on the economy. And the problem is right now, we've been seeing economic contraction in many different sectors in the economy, which make it difficult for incomes to rise very quickly when you're seeing a slowdown in growth in the economy. Not to mention the fact that we're talking about a 58% increase in monthly payments. That's just not practical for incomes to go up by 58% in a matter of a couple of years, which is why housing affordability has fallen so quickly. This brings us to option number two. What about mortgage rates falling? One of the factors that's keeping mortgage rates so high is the Federal Reserve Bank. They're the central bank here in the United States, and they have the ability to influence interest rates. Not mortgage rates, but interest rates. These are the interest rates that banks charge each other when they lend each other money, and this has an influence on mortgage rates because if banks have to pay more money to borrow money, they're going to charge you more money when you have to borrow money. And what they said in their most recent meeting in September is that you can expect interest rates, not mortgage rates, but interest rates to stay higher for longer. Take a look. Federal Reserve officials forecast higher interest rates through 2026, a sign that borrowing costs are not heading back to their rock bottom levels, normal before the pandemic. So if the interest rates that are set by the Federal Reserve Bank are expected to stay elevated for a longer period than expected, well then that generally would mean that mortgage rates are also going to have to stay elevated because that means that the borrowing costs for a bank are going to be higher. So the bank is going to have to charge you more money because their costs are higher. This leaves us with option number three. What about home prices falling? This data is from the National Association of Realtors, and what they found is that the median home price sold in March of 2020 was $280,700. Seems pretty reasonable. Well, by July of 2023, the median home price sold in America shot up to over $406,000. So we're talking about a 44% increase in median home prices in America. So now, what affects home prices? Well, supply and demand. Now, for those of you who are weirdos like me and you like to stay up to date on what's happening with things like the economy and interest rates and the housing market and the stock market and the global economy and crypto, that's why I created Market Briefs as a free resource to help you stay up to date with what's happening in the economy. It is a completely free newsletter that you can join where every day my team's working to break down everything that I just talked about. You can read it in less than 5 minutes every morning. It's a super fun and easy to read email, and I promise you, not only is it educational, but you're also going to be entertained through the email as well. So if you want to join Market Briefs, it's completely free, and you can join Market Briefs by clicking the link down in the description below. If you want to understand home prices and what direction they might be going, you have to understand how supply and demand work in the housing market. The factors that influence supply include things like home inventory, the number of homes for sale, then the number of forced sales, things like foreclosures or people being forced out of their homes, and then the factors that influence the demand side of home buying are things like mortgage rates, things like the general growth in the economy, and things like buyers' interest. Generally, when you have more buyers and sellers, more demand than supply, this pushes home prices up. When you have more supply than demand, more sellers than buyers, this generally pulls home prices down. So let's start by talking here on the supply side when it comes to inventory. 2023 has been a year with low inventory of homes, meaning some of the lowest homes available for sale that we have ever seen. This has kept the supply of homes very low, which has been one of the reasons why home prices have been going upwards. Now the next question is, well, can't we just build more homes? Let me read you the first line of this article. This is an article from Newsweek that was published on September 19th, 2023 with the title, Home Building Collapses as Market Struggles. And the first line of this article says, new home construction in the US plunged in August to a 3-year low, according to data released on Tuesday, as high mortgage rates, increased cost of labor, and the price of building homes took a toll on the industry. So there's two problems on the inventory side. Number one, people don't want to sell their homes, and number two, builders are not building homes fast enough. People don't want to sell their homes because if you own a home and you have, let's just say, a 3.5% mortgage, well, if you sold your home and moved to a new home, now you're going to have to go out and get a 7 or a 7.5% mortgage, which is really unattractive to a lot of homeowners. So a lot of homeowners are saying, you know what? We'll just stay in this home a little while longer. So homeowners don't want to sell. And then home builders are looking at the market saying, maybe we shouldn't build because we don't know what's coming in the economy. We don't know what's coming in the mortgage market. We don't know what's coming in the housing market in the next 12 to 24 months. So maybe let's be a little bit more cautious. Because generally, home builders, the way that they work is they want to build more homes because the more homes that they build, the more money that they're going to make. However, when they build a home, you got to remember, this is a long-term investment. It could take 6 to 18 to 24 months to build a home or a subdivision. So when a home builder is going out and building for the long term, not only do they have to look at where the economy is today, but they kind of have to project where a home price is going to go in the next year to 2 years, because it's going to take time and money to build this neighborhood, and then it's going to take time and money to sell each one of these homes. And if 12 to 18 months from now, when the homes are starting to be built, they can't sell the homes for the price that they thought, then they might have to cut the prices of their homes, which means they might not make money. And home builders, like every other business, does not want to lose money. So this is where now home builders are starting to be more cautious because they want to protect their own interests. However, that means less homes are being built. And if less homes are being built, there's less inventory available. So we've been having this slow inventory issue on the supply side, which has been keeping home prices inflated. But then let's talk about forced sales, things like foreclosures. And what we've been seeing happen recently is that foreclosures have been moving a little bit upwards. However, when you look at foreclosures over the broad spectrum of time, they're still historically very low. And that makes sense if you think about it, because home prices have gone up so quickly. We just talked about that. And if you have home prices that have risen so much, there's really no reason for people to go into foreclosure. Because if you lose your job, if you run into a financial hardship, if you can no longer afford your home, you can generally sell your home for a profit and walk away with some cash. Or even if you don't walk away with any cash, you can generally walk away without having to deal with a foreclosure. Now, of course, are there special instances? Yes. But as we start to see the housing market stall, if home prices start to go down, now you can start to see where people might not be able to sell their home with a big profit, because we've also been seeing home down payments when you go to buy a home dropping. You've been seeing more 3% down payment mortgages, some 1% down payment mortgages, even some 0% down payment mortgages. And so, yes, people are buying homes with low down payments, but that's not an issue until home prices begin to fall, because if somebody goes underwater and then they run into a financial hardship because maybe they lose their job or for whatever reason they can no longer make the monthly payments, well, that's where now you can't sell the home because you don't have any equity. And that's where a foreclosure becomes now more likely. And if you go into a foreclosure, well, then that kind of creates more forced sales, because maybe you didn't want to sell, but the bank is forcing you to sell, or the bank has taken the property back and they want to sell because they don't want to own the property. So this is something to keep an eye on, because we have been seeing foreclosures start to move upwards. But if we continue to see home prices fall a little bit, and if we see more pains in the economy, well, you can bet we would see more foreclosures, which would increase the supply of homes, because we are facing a big supply shortage of homes right now. So now if we move to the demand side, mortgage rates naturally affect home buying. When you have an 8% mortgage, people are less likely to go out and borrow money, because it's going to cost you a lot more than if you have a 2.5% mortgage, because a 2.5% mortgage is very close to free money. Is it free money? No, but it's much closer to free money than borrowing money at 8%. We already went over the numbers earlier today, and what we're seeing today when it comes to mortgage rates is that mortgage rates are at some of the highest numbers we have seen in the last couple of decades. In fact, they are the highest rates that we have seen in more than 2 decades, which means now mortgage rates are higher, and buyers now have to factor in the higher mortgage rates. And we already went over how the Federal Reserve Bank plans to keep interest rates higher for longer, which means mortgage rates could potentially stay higher for longer. That is bad news for demand, because the higher the mortgage rates, generally the lower the demand. Now remember, supply and demand. When you have lower demand, that generally pushes home prices lower, or it would have less upward pressure on home prices, I should say, because now you have less buyers in the market. So you have to balance the demand with supply. Then let's take a look at what's going on in the economy. The economy affects demand because when you have a growing economy, people are seeing big raises, people are getting big bonuses, people are getting big promotions. They want to celebrate and they want to spend this new income on a home. But when you're seeing economic slowdowns, then people become worried about the economy, they become worried about their job, they become worried about their income, they become worried about potential bonuses, and then they become less likely to go out and spend money like buying a home. And what we're seeing happen now in the economy is, yeah, we're still seeing economic growth. However, there are a lot more worries on the economy today about where the economy is going to be in 12 to 24 months. And so that has a negative effect on the demand side of buying a home. Now, to clarify a point on the economy runs on spending. The more money people spend, the more the economy grows. And what we're seeing today is that consumers are still spending money. Yes, you're seeing more consumers dig into their savings. Yes, you're seeing more consumers dig into the credit card debt, but consumers are still spending, even though inflation is still hot. However, we are starting to see the more impact of all this spending and digging into savings and credit card debt with the high inflation, and we don't know when we're going to see the impacts of all this or what that impact is going to be. However, a lot of people are worried about the future health of the economy because people can't keep spending at the current rate that they are now unless we see a significant increase in incomes, and it's hard to see the increase in incomes without growth in the economy. So understand that there's a lot of kind of concerns about the economy, and that could impact the demand side of buying a home. Then finally, we have buyers' intent when it comes to buying a home. And we saw this in full force during the pandemic because when the pandemic happened, people were moving out of the cities and they wanted to move into the suburbs because it was cheaper and they wanted a home where they could have an office. So that naturally changed intent because now people said, well, I want to move into the suburbs. I don't want to have a home in the city. And so we saw rents in the cities fall and we saw home prices in the suburbs rise. Now you're starting to see things slowly start to shift a little bit the way they were before because you're seeing a lot more companies saying you have to return back into the office, you have to come back into the office multiple times a week, if not every day in a week. So you are starting to see a shift in the economy when it comes to intent because, well, the economy and the job market is changing, and that naturally has an impact on homes because you want to live close to where you work. So now as you try to understand the housing market, you have to remember the housing affordability depends not just on what the home price is, but also what the mortgage rate or the mortgage payment is. And today, it seems like mortgage rates are going to stay higher for longer. How high and how long? Well, nobody knows. That's going to be ultimately dependent on the Federal Reserve Bank and a number of other factors. But then we can also look at supply and demand, looking at things like inventory, because if mortgage rates stay high, less homeowners are inclined to sell. And home builders, if they're worried about the economy, unless they get more incentives or grants by the government, they might be less likely to want to go out and build homes. Then to understand forced sales, understanding that if we start to see home prices begin to fall, that could lead to an upward movement in foreclosures, which could lead to more forced sales, which could push up supply. That's downward pressure on the housing market when it comes to home prices. Then higher mortgage rates for longer, also downward pressure on the housing market. However, if the Fed starts cutting interest rates, that could put upward pressure on the housing market, which would also make inflation worse than where it is because then more people are buying homes. But we'll save that topic for a different video. Understanding the economy, if we see more downward movement in the economy, if we see more economic slowdown, that's a lower movement on demand. And if buyers' interests keep changing, well, that's also just going to change the housing market because if people want to buy a home again because now they need to be closer to their work, well, that can also impact the housing market. So now you have to understand that this is just a full equation. And you want to understand how demand weighs in relative to supply because that will help you understand where the housing market is going because it depends more than just mortgage rates. Do mortgage rates affect the housing market? Absolutely. But mortgage rates are one piece of the broader equation. But I will say that mortgage rates have a big impact on the broad equation, which is why it's important for you, if you want to understand the housing market, to keep up to date with what the Federal Reserve Bank is doing, because that can give you a lot of indication as to what direction home prices will go. And of course, we'll be keeping you updated on market briefs, which is why if you haven't joined yet, make sure you do so. Let's talk about investing for cash flow, because unfortunately there's a lot of, let's call it poo-poo information out there on the internet when it comes to the topic of cash flow investing, because a lot of people say, oh, if you want to get rich, just get this passive income, create this drop shipping site, start this Amazon store, create this ebook, and you're going to be making passive income, this cash flow. But the reality is, number one, that's not passive.